Welcome to the weekly update, where I'll go over the action in the market for the week of September 3rd through the 6th, and then we'll see how things look for the week of September 9th through the 13th. Now, we are starting to see a shift on the daily charts. You probably know that we had a down day on Thursday and Friday, but we've been setting up for this. And I started to see this about a week ago, and I started mentioning it in these weekly videos. And then we saw it played out in the daily videos. So we're shifting over. We have the defensive areas of the market that are holding up a bit better, and some of the growth areas and the mega caps and the stocks that really drive the indexes higher, they're seeing some weakness right now. They had a pretty good day on Thursday, but we didn't see any follow through on Friday. So before I get started into the video, please know that this is just one of many videos that I do. Even if you're a longer term investor, you may get some value out of watching the daily videos when you're able to do that. I know my videos are longer and I talk about a lot of different things. That's all by design. And it's what I found over the decades really works the best. It's what you don't know that can really mess things up. And so I cover everything knowable and that seems to have an impact on the S&P 500. There's a PDF in the description below this video and every video that I post. Every day I update the YouTube community tab with pivot points, and they change every day on an intraday chart, but then there are other pivot points that last for the whole month. I do have a private Facebook group. Now, in addition to that, I have a program, and it's free and anybody can join right now. But if you're not interested in that, or you're not a member and you are a member of Facebook, you might want to check out the private Facebook group. Not really active. I really just post whenever there's a video available, but it's a way that you can access me. I communicate with a lot of people using Facebook, and so I'm pretty much always on there. And it's a pretty good way to be able to communicate with me if you have a question or a comment or what have you. And I really watch the YouTube and Rumble comments. I don't mind legitimate comments, even if you disagree with something I'm saying or something that I'm doing. That's fine. I have no problem with that. It's the garbage and crap comments that I go in and delete, especially on Rumble. I haven't really had too much of a problem lately on YouTube. And I do post on Rumble and YouTube. And sometimes I may have trouble uploading to one platform or the other. Feel free to check me out on the other one if you can't find a video and you're looking for it. Here is the link to that. Also, as I mentioned, there's a thing called the SPXInvesting Program. There are additional videos and additional information. I will be locking that down soon. I've delayed that due to an upcoming trip that I don't really know if it's going to happen or not. But there are additional courses and you have access to me and you can ask questions. So feel free to check that out if that's something that interests you. And there's a link that'll take you to the website and a link that will also take you to an overview video. And one of the benefits, even that you get right now, even though everything is free, if you like to have immediate access to the daily and weekly videos, you get that as a member, where they're delayed now on YouTube and Rumble. And then the daily video is the real foundation of what I do. This is the intermarket analysis video, not necessarily meant to be used all by itself. All of these videos are meant to feed into the daily video and be used together. Okay, let's go back and talk about this week's session. We were down 4.25%, kind of a bigger loss than what we've seen in a while, and we were still below average with volume. The interesting thing here is on the down days, that's when we saw volume really picking up, and that's a bit of a concern. We're still positive here on the weekly charts, but we're showing some damage, and we're turning negative in the short and intermediate term on the daily charts. We're still positive in the long term on the daily charts, and I'll go through and we'll talk about these. And it had a lot to do with the employment situation report. Now, I think the market kind of wanted to sell off anyway, and we were seeing signs of that as we were going back to last weekend and then seeing the charts develop throughout the week. And we're coming into a weak seasonal time. Usually it's the latter part of September when things get weaker. Now we're seeing some weakness here at the beginning. And of course, all the perma bears, they just know that this is it, baby. This is what we've been talking about for 20 years, man. And it's finally happening now. Well, everybody has an opinion, and we just follow the charts and let the market tell us what's actually happening. And the Fed is probably going to cut rates coming up on September 18th. They pretty much have said they're going to do that. We just don't know how much they're going to cut or what they're going to actually say out of that meeting. We want to keep an eye on the geopolitical things going on. In fact, that's one of the reasons for this trip. I don't know if it's going to happen or not due to things going on in Israel right now. And then there's the debate going back and forth. And part of that came to the surface again on Friday with the employment situation, because it's been holding up. Now we got the report out and it was okay, but not as good as the market had been hoping for. And that's what they used to justify things going lower. If we had seen it stronger than expected, they would have gone lower because of that. If it was even weaker than what came out, we would have gone down because of that. I think the market wanted to go down on Friday and just used any excuse to do it. Okay, and we are getting a little tentative here with our trend. It's a weakening trend. We're still positive, barely. The green line is just slightly above the red line. It's kind of hard to see on that chart, but I will show it to you and we'll look at that. Okay, so here are some bullet points. All of the indexes or indices, if you want to say it the correct way, declined this week. The S&P did end up closing down below its 50-day moving average. We had the 20 and the 50 period on the daily chart kind of on top of each other, and they were both providing support and did for Wednesday and Thursday and even going back to Tuesday. But then we finally broke below that on Friday, and that is some kind of significant intermediate term, at least on the daily basis, support that we had broken through. Now we're going down and looking at the daily chart with the 100 period moving average. So there are fears about the weakening labor market because the employment report came out and it was not so bad, but they also came out with revisions to previous reports and they revised those down. And so it's like, man, because remember at the beginning of August, that's what started the whole freak out that happened on August 5th. It started the Friday before with the employment situation report. And that's when, oh my God, we have to have emergency rate cuts right now. And we're going into a recession. Well, that report actually was revised down. So it was even a little bit worse than when we actually heard it the first time. So the report that came out on Friday was not well received. It was lighter than expected. And as I said, there were downward revisions to previous months. We also get a lot of other employment data throughout this week coming up to the employment situation report. The ADP employment change, it was weaker than expected. But then on Thursday, we had initial jobless claims, which were better than expected. So it doesn't show that things are falling apart from that angle. And then we also got the second quarter productivity report. And this is kind of interesting. This is good if you're a shareholder because it's showing that companies are being more productive and paying people less. So you kind of like that. You may not like that as an employee of that kind of a company, having to work longer and not getting a raise for it. But if you own stock in that company, that might be more to your benefit. And then the ISM services, this is non-manufacturing. It was better than expected. So we're seeing some kind of, okay, this is better, this is worse, this is just about right. We're not seeing a whole cohesive story right now. Megacaps, tech, and semiconductors declined. These are the growth areas. These are the areas that you want to buy low and sell high. When these areas suffer, the indexes suffer as well. Interest rates did fall. We're clear down to 3.71% with the 10-year yield after Friday, where a week ago we were at 3.91%. The dollar also declined. Okay, so here we go with the indexes. They were down 2.9%. Just a week ago, the Dow set an all-time high. Now it's 2.9% off of that. The NASDAQ got hit pretty hard, down 5.8%. The S&P that I'll show you later here was actually 4.24%. They just round it down here. And the Russell, the small caps, they were down 5.7%. You know, this great breakout, lower interest rates, supposed to be great for small caps. Well, where's the love now? It's just not happening right now. As I talk about every week in this video, this is a chart that I've been showing for well over a year now. And this is showing how inflation has been coming down. And we're trying to get a bigger picture look with this chart. We are still declining, but after that, we saw just massive inflation going up. We don't know if it's going to play out that way or not. We just want to watch things as they unfold, keep an eye on these economic reports, and then adjust things accordingly. And then we're down at 3.71% with the 10-year yield. That's under the 4.02%. According to the Renmac research, this suggests that, okay, this isn't really biting into corporate profits or corporate earnings. They're not having to pay out more in interest. This was updated this week, and we are seeing this going up. These are folks that have been unemployed for over 6 months, and that is, even though it's slowing down a little bit, is continuing to go up, and that's showing some weakness longer term in the employment situation. Then we still have earnings looking good going out into the future here. And this is the first small outflow of U.S. equities going back to June. Okay, I'm not into the since June stuff. That was just a few months ago. But we're seeing money coming out of the market. And people know that this is a weak seasonal time. It might be a self-fulfilling prophecy here. They think it's going to be weak, so they start getting defensive and getting out of stocks, and we're seeing money, actually starting to see money coming out. The Fed funds futures curve right over here, this is where we're at right now, and they expect it to come down. And then we don't know what's really going to happen here, but going into 2026, 2027, all the way out to 2029, right now anyway, they think interest rates will be going back up after that. And then the yield curve. Now, this is interesting. In Friday's session, we had the 10 to the 2-year yield curve uninvert. And it had been inverted for over 2 years now, almost 2.5 years. It was like June or July of 2022. So not 2.5, but still a long time. And a lot of times, and you might run across other videos on YouTube or Rumble, oh, this is it, baby. We've gone uninverted now with the 10 to the 2-year. The countdown, the stocks are going to crash. And that may happen. We don't really know how things are going to play out. But we have just as much evidence that I look at anyway that suggests we will not go into a recession as suggests that we might go into a recession. We'll watch all of that information together, reach our own independent conclusion, and then go from there. All right. And then because we had the employment situation report, this is something that has been a warning sign for a while now. We look at all employees and temporary help services. That's the red line. When it drops down below this other thicker red line here, a lot of times that signals that we're heading into a recession. We saw this really decline, but we have not, at least to this point, gone into a recession, and we're going back up a little bit here. This is one of the things that we're watching just to keep an eye on. We call it recession watch. And then this is kind of an interesting chart here. This is when non-farm payrolls, the growth in 12 months around the U.S. recessions. We don't even know if we're going to go into a recession. But this is 12 months out, and then this is when the recession happens and how stocks go in the toilet, and then they start bouncing back up within about a year after that. It's a little premature, in my opinion, to really be focused on this, although this can be a little bit of a handy chart. But the takeaway here is things are generally going okay before the recession, then things go bad during the recession, and then they start to slowly get better. All right, then here's the yield curve, suggests higher VIX for years. We don't know that, because we have the 10 to the 2, which is inverted here, because they flipped it upside down, and then the VIX. So, yeah, okay. And then they say that the spread is a 2-year lead. Okay, fine. I mean, we'll just watch that. But to put out a dogmatic blanket statement, we don't know if it's actually going to play out this way. And then biggest weekly outflow from treasuries. Now, bonds have been pretty good in 2024, especially lately. And yet we're seeing a lot of money going out of these bonds. All right, then FactSet did have a blog post, and it's kind of an ambiguous question. Are analysts cutting earnings per share estimates more than average for the S&P 500 companies for the third quarter? The takeaway from this, looking at these charts, no. It's about average. They're not cutting them any more. They're not necessarily cutting them any less. Then looking at our intraday chart where we gapped lower on Tuesday and just really went down. Not a good month or day to start the month here. We went lower. And then Wednesday we chopped sideways, at least held up a little bit. Then on Thursday we ended lower. And then Friday was when we looked like we were actually going to go higher. The initial reaction to the employment situation report with the futures before the market opened looked like it was positive. And we actually had a positive open. but then that was left in the dust, and we closed pretty much at the low for the day and for the week. So we were down on with all the major indexes across the board, looking at just the 4 trading days this past week, with the NASDAQ 100 and the NASDAQ being down the most. Going back to the beginning of the year, though, we have the S&P now looking about the best. Now, the NASDAQ 100, everybody wants to be in the QQQs of the NASDAQ 100 when it's going up. But when it's going down, it tends to go down faster. That's another reason why I prefer the S&P 500. It may not go up as fast, but it doesn't go down as fast either, because there's 503 stocks in the S&P, a little more balanced. It's not so heavily tech laden. And so it just tends to hold up, and it's a better benchmark of the U.S. Stock market as well. But we're still positive on the year, going back with all the indexes. Looking at the sectors where we were down, but real estate, actually, even though it was unchanged, it held up the best. But all the other sectors ended up declining, where we have the growth areas: tech, discretionary, communication. These are the areas we want to see going higher. This is what drives the indexes higher. They were down the most this past week, and a lot of this came on Friday. And then we look at the scooter score, looking at that individual sector. What is looking the best right now? Utilities are still strong in the 90s, with real estate, staples, and the financials are still in the 90s. Now, 3 of these, utilities, is kind of a toss-up. Is that defensive or not? Real estate, they like the fact that interest rates are going down. Staples, they are more defensive. And this doing quite well has been causing us some concern for a while. Another defensive area is healthcare. It's not looking as good on a scooter score, but it has been holding up a little bit better. And check out the intermarket analysis video, where I go through all of these different sectors and compare them with the S&P 500. So looking at how things have been performing here. Okay, this looks kind of strange. This actually goes back a little bit longer here, but staples, real estate, utilities, healthcare, these are the more defensive areas, and they've been holding up better lately. And we go back to the beginning of the year with financials, which are still looking solid. They were down on Friday, they got hit, but they've actually been hanging in there. And for right now, that bodes well for banks and for a financial crisis. If we start to see that really tumble over, that's going to cause even more concerns. And then utilities have been strong lately, and then communication overall, where all the other sectors are down year to date, the way I measure them on this chart. And then we look at the relative rotation graph. We have real estate looking the strongest now. Now, it was not too long ago, way over here in the minus area, and it's really been showing some strength as interest rates have been coming down. We're also seeing a pickup in utilities lately, the financials. We have staples. This is healthcare. See, these are all defensive areas. And when the market starts getting into these areas, this is what happened at the end of 2021, right before we got into 2022. And this is a warning sign to us. Okay. Are we just pulling back right now? Is this just a normal profit-taking season that we're going through? Or is the market really shifting gears and is actually going to have some serious downside, at least until about the election or so? And then looking at everything here, where real estate, utilities, and staples, defensive areas. Real estate is more of interest rate sensitive here. And we have materials, industrials, discretionary, healthcare, and financials. They're more in the middle area right now. And we have energy, tech, and communication. Tech and communication are growth areas, and they've been weaker lately. And then looking at the indexes, where we have the utilities still coming on strong here. Small caps have been showing some improvement, but did not have a good week. The transports are showing a little bit of improvement. The Dow Jones Composite Average is looking a little bit better. And the mid caps are coming off, looking a little worse. And then the areas that have really been helping the market overall, the S&P 500, the S&P 100, and the NASDAQ 100, they are now starting to show some weakness. And here's a look at this. Utilities are still looking strong to this point, where we have the S&P 100, NASDAQ 100, and S&P 500 showing some weakness right now. And then just to do this is just a kind of a silly thing here. This is predictit.org, where you can actually bet on who you think will win. It's actually tightening up a little bit. It's getting a little bit closer here. And then looking at sentiment here, where we were actually up into the positive area. We got into the 50s and into the 60s there for a while. Well, as we've been going down and seeing a lot of selling going on, we've dropped through the neutral area all the way back down into fear. So we're coming in right now at 39. And here's how it looks, where we were looking more positive. A week ago when I did this, we were above 50 and looking okay. Well, now we're starting to drop back down as we're seeing selling coming into the market. And here's another sentiment indicator, getting all the way down, not giving us an extreme reading. In fact, possibly even in danger of dropping below zero here. Here's the active asset managers. They're really not showing any kind of an extreme reading right now, coming in at 70.65. When they get 90 or 100 or so, that's when it's, and even 80, that's when we start to really use this as a contrarian indicator. We are seeing the ulcer index showing that fear is increasing, and we're starting to cross above the moving average on the daily chart. This is going back up now, showing that cash is actually outperforming tech currently. When this is declining longer term, that means tech is outperforming cash. The RIDEX bear bull ratio, and this does not take Friday into account. There's a 1-day business day lag here, where things were still fairly positive, and this is probably going to spike up after Friday's decline. We want to keep an eye on this. The spread between risky and not as risky bonds, and I guess the next chart, where is that one? It's somewhere in here. I guess I'll deal with that when we get to it. We also want to look at the chart here of small caps versus the tech sector. When this is going down, that means tech is outperforming, and we're seeing this starting to bounce back up here on the weekly chart. It hasn't switched yet. We haven't gone over to small caps outperforming tech, but we just want to keep an eye on this. But we've seen other bump ups like this before, only to have the market come back and get itself under control. The VIX really going up now. We're above 20 here on a closing basis, both with the line chart and the bar chart. And this is what typically can happen around this time of year during an election year. We see the VIX starting to go up. And when that's going up, that means stocks are going down. All right, then we look at the VIX and a 3-month ratio of the VIX here, or 3 months average of the VIX. This is starting to turn back up, which is more negative for the market. That means the shorter term VIX is outperforming the longer term VIX as measured by this chart. And we're just barely starting to tick back up here. Overall, we are declining with our 253 period moving average of the equity put call ratio, but it is ticking up just a little bit. The latest reading from the American Association of Individual Investors, not getting an extreme reading, but still positive here, just under the about 28.4 is the latest reading. Still looking pretty good. We did have another update of GDP, not a real big change here, coming in a little bit over 2% with the GDP now, and this is starting to scrunch up a little bit as we're getting more revisions to GDP being released. We're at about 2.33% to the upside and about 1.5% to the downside. And then this, what I take away from this is all of these are positive going forward from here. A recession means that we go into negative GDP for 2 consecutive quarters, and we're not seeing that even projected yet. Then we look at the Chicago National Financial Conditions Index. This is still below the black line, so we're doing okay there. This is what probably a lot of the perma bears are talking about. This is called the SOM Rule Recession Indicator, and it was updated on Friday with the employment situation report. Now, a month ago, what was freaking everybody out is we came in above this red line at 0.53. Well, after Friday that just ended, we're at 0.57. So we're going a little bit further above this red line, and that is cause for concern because a lot of times, if you look here, when we got above this red line, that's when we ended up going into a recession. Now, SOM herself is still around, who developed this and is on Twitter. You can follow her. And even she's made statements saying maybe this time what I invented and found out is not necessarily what's going to happen. So even the creator of this is a little doubtful right now, but still we pay attention to this anyway. And then looking at the US recession probabilities, we're coming up, but we're still below the red line currently. And then this is a quarterly report, not really giving us any insight right now. The Brave Butters Kelly leading index. And last time we had this come out, it was coming down. Inflation, not really changing all that much this week. This wasn't really an inflation week. That'll be upcoming. We're going to get CPI and PPI coming out in the upcoming week. And then what's the Fed going to do? They are going to cut rates. There's a 100% chance here, 70 to 30%, but it's still heavily in the camp suggesting that there's going to be a 25 basis point or 1/4% cut. And it's pretty much getting more locked in right now. And what is the November 7th meeting looking like? Looking like rates are still going to be going down from here, but this is going to change a whole lot depending on what's happening with the markets, what's happening with economic reports. And this just shows how it's been changing, but folks are still anticipating rates being lower at the November meeting. And the Fed balance sheet here, and I always make a joke about this. This is the only a government chart can be going down when you see it on the line, but going up when you look at the number. This is the year-over-year change where we actually see it flattening out here and actually declining a little bit year-over-year. We want to keep an eye on this. As long as we're just pretty much going sideways here, that means that the banks are doing okay for the time being. Man, looking at breadth, we're coming down, but still above an advancing moving average based on price and volume. We're declining a little bit faster based on volume, and that's a slight concern to us. And we're seeing a little drop off here with the new highs minus the new lows. The new highs really contracted. We saw a bit of an expansion with the new lows. We're rolling over, but we haven't crossed below the moving average here with the 4-week. And we're starting to top out, but slightly increasing here with the 10-week. And we're declining, but still positive with the advanced decline ratio. And we're also coming down. Now we've turned negative on the daily chart with accumulation distribution. This is a smart money indicator. It not only takes price into account, but volume as well. And this is showing some weakness now, but we have crossed below the moving average on the daily chart. We're coming down, but still positive here on the weekly chart. Our trend, and this is what's kind of hard to see here. The green line is just barely above. We have a reading of 27.33. Okay, that's the green line. The red line is 27.28. I mean, they're almost right on top of each other, and you get all this other mess on the chart, and it's really hard to read. But we are seeing a weakening trend. Now, on the daily charts, we've started to turn up, but we're still not trending on the short-term chart, but it looks like it could be developing into a negative trend. The intermediate term trend, that's what I really focus on. It's barely starting to turn up above its moving average, but still below 20. So we're not trending yet, but the red line is on top. So we're looking more negative here. This is holding up a little bit better, but also looking vulnerable at the same time. The Erin still above 0 with the oscillator. That's positive. And the mass index. Now we had a signal on the daily chart, not a signal here, but it took a couple of weeks for it to happen, but that looks like it could have been a valid signal on the daily mass index chart, but nothing here to see. And we did drop below the 50-day moving average. We held on to that until Friday's session, and that's when we really started to drop down. And if you notice the down days that are in red at the bottom here, those were the above average with volume days. Otherwise, we were below average. So we are negative in the short term. When we look at the S&P, mid caps, small caps, and triple Qs, we're still positive, except for the NASDAQ 100 in the intermediate term. We're still positive in the long term with all the indexes. And so we're negative in the short term, positive with bonds based on price across the board. We're negative across the board with commodities and the dollar. And not really seeing any real damage here. This is a very long-term chart. And we didn't come up to the upper end of this trend channel, and we're not really coming back down to the midpoint, at least yet. This is a little bit of a concern. This is another weekly chart where the S&P dropped below this R2 level. This had been a pivot point that the market was able to hold on to, and we did fall below that. And we are coming down, but still above the moving average here based on 50 weeks. And when we do our moving average crossover, we're crossing down below the 13-week moving average, but the 13-week is still above the 50-week. And we're really coming down here with the McClellan oscillator, but we're not quite extreme negative, at least yet. Coming down a little bit, but even on the daily charts, this is more encouraging. The bullish percent index, not only for the S&P, which is what I show here, we're seeing and holding up for the NYSE, which is a broad market measure. Now, it is showing weakness, and we're actually turning negative with the NASDAQ 100 chart. But this is rather encouraging. This means that most stocks inside the S&P are not necessarily generating point-and-figure sell signals right now. What makes this go up is when they generate point-and-figure buy signals. And we are looking more negative here with the Swenlin trading oscillator. We're breaking below zero based on price and volume. And we're looking extreme with the summation index and starting to tick back down. We never became extreme based on volume. This is still positive, even though it is declining. All right, then we look at the PMOs, our momentums. It never really did switch back over to positive after that decline that we saw in late July into early August. It tried to bounce back up, but it just never really got there. And so we're starting to see some weakness here with the PMO. We came down, but we're still positive based on price and volume, where we're turning negative now on the daily charts. And we're actually getting extreme negative here with the PMOs that are rising. We're seeing that same signal on the daily chart. The buy signals are declining, and the PMOs that are above zero are also declining. And we're just at the midpoint here with the Bollinger Bands. We're coming down to the middle area right now. So here's our momentum. We have the slope and the TSI. These are our shorter term oscillators. They're going down. The MACD, the PMO, and PPO are intermediate term. They're still declining. And we're also seeing this on the daily charts, where we never did turn back to positive with the TRIX and KST, which are longer term oscillators. We're rolling over and haven't quite crossed over negative yet on the daily charts. Then the Chaikin money flow. This is still looking pretty good. And it is showing some weakness on the daily chart. And the red line is starting to turn back down. But here on the weekly chart, it's still going up. And the Chaikin oscillator, it has turned negative on the daily chart. We're below the midpoint and declining, where we just saw a little bit of a tick down here. The force index is turning more negative. We're dropping below 50 with the money flow. That's negative. And we had a down week. And so our rate of change from one week to the next was negative. But we're still looking okay when we go back 50 weeks. We haven't really seen much of a decline, at least yet. We are extreme negative already with the Stochk RSI. We're also seeing that on the daily chart. And we never did come over positive here with the Special K weekly chart. We're still positive with the daily chart. And we're coming down, but still above the midpoint here with the Williams percent R. And we're dropping, but still above 50 with the RSI based on 14 weeks. Dropping, but still above 50 with the ultimate oscillator. Copic curve, we've already changed over negative on the daily chart. Now that's being confirmed by the momentum here on the weekly chart. The vortex, we just crossed over negative with the red line going above the green line on the daily chart. We see some weakness here with the green line coming down, but we're still positive on this chart. And we broke below this 10-week moving average here. We're wondering, are we going to come all the way down to this 40-week moving average now? So we're looking a little more vulnerable on a trend basis where we've switched over negative on the daily charts. We're seeing more negativity here with the Heikin Ashi. Also looking more negative here with the Kegi chart, but we're still positive with the Renko chart, and we're still positive with the three-line break. So these haven't switched over full-blown negative yet. We did have enough of a decline to see the point and figure chart draw in 3 new zeros this past week, but no signal has been triggered yet. And we did start another 50-day cycle here back on August 19th. And we were going sideways for a while. And it looks like we're possibly breaking to the downside here, unless we see a really nice bounce. When we look at our PPO studies, long-term, now this is a weekly chart, so that makes it really long-term when we look at the long-term part of this, starting to decline, coming down in the intermediate term, negative in the short term. Ease of movement coming down, but still above zero. Now we have gone negative on the daily chart. And then we're negative here. We had green bars going up with the Elder's Impulse system. We're negative on the daily chart and negative here on the weekly chart. And we're still positive here. We have the dots underneath. It was thought that with the big decline that we saw on Friday, that a dot may go on top, but it hasn't done that yet, where we've already switched over negative on the daily chart. Okay, and this is just looking at the S&P coming down, the mid caps, which never really broke out of this range. The small caps, which have been frustrating in 2024, every time they seem to really start to break out, they just come right back down. It's like a boomerang or something. And then looking at September, not very good. Over going back to 2020 here, where we haven't had a single up September during that period of time, and we're down 5.4% on average. Okay, looking at the Dow, haven't quite come down to the 13-week moving average, at least yet. We are coming down below the 13-week here with the NASDAQ chart and the NASDAQ 100 as well. And we're seeing a big, fat, thick red candle here for the QQQs or the NASDAQ 100 this way. coming down and dropping below the 13-week moving average with the mid caps, and the small caps closed below it as well. The NYSE still looking pretty solid though. It declined. It got hit over 3.25% here, but it hasn't come down to its 13-week moving average. But so far, this is holding up fairly well. The Wilshire, this is a daily chart where we were camped right along the 50-day moving average. We broke that on Friday. All stocks also coming back down and hitting their shorter term moving average now. And then the big software companies, they're still in an uptrend, but they were also down 3.85% on the week. The FANG index falling below its 13-week moving average right now, down over 6%. ARC, of course, it had to be down. No matter what happens, it seems like it's in a downtrend, not only on the daily chart, but here on the weekly chart, it was down 7.21%. But the banks are holding up fairly well, even though they were down over 5% here. We're still above 50 here with the RSI. And we're just really chopping around right here, but possibly turning negative with momentum. And they're still showing money going into banks. And that's more of a confidence thing that I look at here. And we look at a weekly chart of Dow theory, where we came back and set an all-time high that was not confirmed by the transports. The transports haven't set a high going unless you go back to 2021 here. And then the utilities have been strong lately. And that can be more of a defensive area, depending on what the focus is. All right, then looking at the CRB index, we've crossed over negative on the daily chart. We're also showing some weakness here on the weekly chart. Oil continues to drop. This might really go up if things escalate in the Middle East, but now we're down under 70. Copper is actually down a little bit less here, but it's really been choppy lately. If folks start worrying about the economy, copper tends to go down. If they're more positive on the economy going forward, then copper tends to go up. And gold is pretty much going sideways these days, but still in an uptrend. Silver not breaking out to a new high yet, but also in an uptrend. And the dollar is in a downtrend, not only here on the weekly chart, but also on the daily chart. And this may actually give some support to stocks. We look at bonds based on price. They're doing quite well right now. The total bond ETF was up on the week. And we look at the stock to bond ratio coming down. And for the first time in quite a while, we're actually dropping below the moving average. Now, this is a monthly chart, and we've just started September. So just because it's down here now doesn't mean we have to go through all of September before this gets drawn in here. Okay, we are showing a real decline in the yields across the board. Here's a weekly look with US, UK rates and German rates going down, as well as Japanese rates. All right, then we have gold still looking the best going back to the beginning of the year, followed by stocks, even though they're under pressure right now. Oil just boom, it went down, and it had been doing a lot better, but it really dropped off this week. And then we have the dollar, which is holding up fairly well. And now bonds based on price are back to being positive on the year. And we look at a ratio between the NASDAQ 100 and the S&P, showing how the NASDAQ 100 is underperforming. The S&P 100 short term is underperforming the rest of the S&P 500, but still outperforming longer term. Growth to value. This is another area we've been watching. We want growth to outperform value. That's when the market really goes up. When value really starts to outperform, that means the market is getting more defensive. And we look at bonds to stocks here, starting to spike back up again, but still declining longer term. Gold to the S&P. Well, gold's been holding up a little bit better as stocks have been under pressure, but not really showing anything all that decisive here. And then gold to the dollar, as the dollar's been seeing some weakness and gold's been holding up better. That shows that gold has been outperforming. And energy to tech, energy just got hit and tech's been getting hit. So really no change in this overall ratio. Low volatility against the SPY. This going up is a little bit of a concern to us, but not enough to change the downtrend, at least yet. Discretionary to staples. Also, this going down is not really positive. We're also in a downtrend here. This means staples are outperforming, and that's a little bit of a concern to us as well. And then here's the chart, small caps to tech, where this is starting to go back up right now. And then we look at the NYSE breadth thrust. We are still working off of the same signal that was generated way back in October 2022, so almost 2 years ago. We did have a really high reading with the SWAG NYSE breadth thrust, but it was not an official signal. but that's positive nonetheless. And here's the chart. When we do get these valid ZWAG NYC breadth thrust signals, when the further out you go, especially on a year basis, we're positive every time. All right. And then looking at the weekly chart here, going back to the 1987 crash, pulling back here, but still hanging in there. Here's another look at how we're getting a little bit closer here to this trend line, the same trend line, going back to 1987. We're still on a full-on Zohorchak buy signal now, and we're dropping down below this trend line when we look at the NASDAQ 100 weekly chart going back to 2009. We're still going up here with the new highs minus the new lows on the NYSE, and that's better for the broad market. And this is a 50-period moving average of the new highs minus the new lows. This is the S&P 500 new highs minus the new lows. This is starting to tick down slightly right now. And we're coming down just a little bit, but still at a very high reading when we look at the NASDAQ 100 to Dow ratio. And we look at the Qs to small cap ratio. They both got hit this week, and so the ratio didn't change all that much. And we look at the cumulative NASDAQ new highs minus the new lows, pretty much going sideways now. And then we are coming down here with the 3-month yield. We want to keep an eye on this because this is what led us into 2008 and the great financial crisis. We want to know the context. Why are interest rates falling? But the 3-month yield has been coming down. And now we have another one of these things called the Hindenburg-Ullman. This is the definition of it. You can pause and read through this. I'll just go through it quickly on the next chart, where there are 3 different criteria that need to come together for something to be drawn on this chart. And stockcharts.com has an indicator that does all of that for you, where we did have another spike up here. Now, what has to happen between September 5th, when the first one was generated, that was Thursday, and October 3rd, that's 20 trading days out. There has to be another spike up here for this to be valid. Be aware of the perma bears who say, we have a Hindenburg-Ullman now. It's not confirmed at this point. All right, then seasonality, where typically we see things holding up a little bit better in the early part of September, and then they have a tendency to be weaker going into the latter part of September into October during an election year. And we're also seeing where September is weak going back to 1950. Also looking at this on a world basis, September is pretty weak. Also weak here during an election year, during September. And also we look at September and October, which going back to 1928 have often been negative. And the first half tends to hold up fairly well of September, where it's the second half that tends to be the most negative. We'll just have to see. Maybe it's reversing this year. And then looking at September and October together, where even though August held up fairly well, September and October tend to be rather weak based on this study. Excuse me. And then September to October, looking about the NASDAQ and S&P, they're both negative pretty much across the board here. And then it says, wake me up when September ends. This is another study showing how September is weak as well. And then we take the period from August through October, and that tends to be a weaker time even during an election year. And then here is the election year, which quite often we see more of a decline than when we don't have a presidential election coming up. And then looking at the stats, we're 9 for 9, where it's 50% with the S&P, with the return being down 0.4%. Thank you. I really hope you found this helpful. Have a great weekend, and I will talk to you in the next video.